Last time, dividend yield asked, how much cash do I get compared with the stock price? Now we ask the harder question, can that cash payment survive? Imagine 3 companies. Each one pays a $4 dividend per share, same dividend, same cash payment to you. But one company earns $10 per share. One earns $4 per share, and one earns only $2 per share. Which dividend is safer? Pause on that for a second. The dividend did not change. The support behind the dividend changed. That support test is payout ratio. Dividend yield compares the dividend with the stock price. That is useful, but price is set by the market. Payout ratio looks inside the business. It asks, out of the profit the company makes, how much is being paid out as dividends? If the business earns a lot and pays out a little, there is room. If the business earns a little and pays out almost everything, there is no room. And if the dividend is bigger than the earnings, the company is paying out more than it made. That can happen for a while. It cannot be the plan forever. Start with 1 share. For that 1 share, the company earns $10. That is EPS, earnings per share. Now, the company pays a $4 dividend per share. So $4 leaves the business. $6 stays inside the business. The payout ratio is dividend per share divided by earnings per share. 4 divided by 10 equals 40%. So a 40% payout ratio means for every dollar of earnings, 40 cents is paid as a dividend and 60 cents is left as cushion. That cushion is not wasted money. It can fund new projects, it can pay down debt, it can protect the dividend during a weaker year, it can even support future dividend increases. This is the first aha. Dividend safety is not just the size of the payment. It is the room behind the payment. Use matching units, dividend per share goes with EPS, total dividends go with total earnings. Do not mix 1 share with the whole company. Now keep the dividend exactly the same. $4 paid out, but this time the company earns only $4 per share. 4 divided by 4 equals 100%. That means the whole earnings bucket is being drained. There is no cushion. The dividend might still be paid. But now there is less room for mistakes, lower sales, higher costs, debt payments, or 1 bad year. 100% is not automatically a dividend cut. But it is the line where beginners should slow down. At this point, even a small drop in earnings can push the dividend above what the company currently earns. Now keep the dividend the same 1 more time, $4 paid out. But the company earns only $2 per share. 4 divided by 2 equals 200%. That means the dividend is twice the earnings. Where does the extra money come from? Maybe from cash saved in the past, maybe from borrowing, maybe from selling assets. Maybe this is just a temporary bad year. So above 100% does not always mean the dividend is gone tomorrow, but it does mean the dividend is no longer fully supported by current earnings. That is the warning. 1 year can be noisy. The trend tells a better story. Imagine payout ratio moves like this: 40%, 55%, 70%, 95%, then 130%. The dividend might look attractive the whole time. The yield might even look higher if the stock price falls. But underneath, the cushion is disappearing. This is where 2 numbers can disagree. Dividend yield can look exciting. Payout ratio can look stressed. When that happens, do not let the exciting number silence the warning number. This is why a dividend can look generous right before it gets cut. The high yield gets attention. The payout ratio explains the stress. There is one more beginner trap. Dividends are paid in cash, but EPS is an accounting number. So payout ratio based on EPS is useful, but it is not the whole test. You also want to ask, is free cash flow supporting the dividend? Do not turn this into a complicated cash flow lesson yet. Just remember the simple idea. Paper profit can look fine, but dividends need usable cash. If earnings support the dividend and cash flow supports the dividend, the payment is stronger. If earnings say yes, but cash says no, slow down. Payout ratio also depends on the type of business. A fast-growing company may pay no dividend because it wants to reinvest. That does not automatically make it bad. A mature utility may pay a higher percentage because its business is steadier. That does not automatically make it safe. And some businesses, like REITs, are often judged with cash flow style measures, such as FFO or AFFO, not plain EPS alone. The point is not to memorize one magic number. The point is to ask whether the dividend fits the business. Here are the beginner mistakes to avoid. Mistake 1, a higher dividend is safer. Better question, how much profit supports it? Mistake 2, a payout ratio under 100% is always safe. Better question, is the trend getting worse? Mistake 3, one bad year proves the dividend must be cut. Better question, is this temporary or is the business weakening? Mistake 4, Xiao. EPS support is enough. Better question, does cash flow support it too? Mistake 5, payout ratio tells me what to buy. Better question, does the dividend, business quality, debt, and cash flow all tell the same story? Here's the final rule. Dividend yield tells you the cash payment compared with the stock price. Payout ratio tells you how much of the company's earnings are being paid out. A low payout ratio can mean room. A high payout ratio can mean pressure. Above 100% means the dividend is not fully covered by current earnings. But always look at the trend, the cash flow, the debt, and the type of business. Payout ratio is not the answer. It is the dividend survival question. This is education only, not financial advice. Next, if a dividend can survive, the next beginner question is, what happens if you reinvest it? That is DRIP investing.